Hi traders, this is Forex James, and in this episode we'll be discussing on when we should be using buy stops and sell stops for our entries instead of using just a market order or a limit order. Okay, so let's pause for a moment and let's define what a buy stop and a sell stop is. Okay, so a buy stop essentially means that you are buying at a worse price than the market price. Okay, and a sell stop essentially means the opposite, selling at a worse price than the market price. So in real life, when we're actually buying a product, it's not common for us to say that, oh wait, price is at $10 now, I'm gonna buy it when it hits $12. Nobody does that in real life. Okay, so why would we wait for price to hit $12 when we could actually jump in at it at $10? Okay. However, with that being said, there are times in the market when I do use a buy stop instead of a limit entry or a market entry. The reason for that is because I'm giving up my pips for the extra confirmation of price action that I need to see in the markets. Okay, so let's take a look at some examples here when we should be using a buy stop for entry. Okay, let's take a look at this chart here. Okay, let's zoom in into this area here. So as you can see, price has been ranging here. And eventually it broke, but this is considered to be a false break in my definition, okay? Because this is here, this is to trap the breakout traders into selling this. And what happened is that it became profitable for just a few pips. It retraces, okay? And what happens here? This is an area where the retracement traders get it. Oh, you know what? I'm gonna get it on a pullback, okay? And then what happens? Both traders are wrong. Price went up the other way. It went to the upside. Okay. So in areas of manipulation like this is usually when I would use a buy stop to enter the market. Alright, let's zoom out a little bit here because I'm pretty sure this is a demand level on the bigger picture. There you go. See where we are? Let's change this color. So on the daily, we're actually sitting on support. Okay, a really respected support that has been tested many times. And that's on the H4. Whenever we're nearing a big level like this, people are jumping into the markets. Okay, they're trying to get good prices to go along. Those who are buyers. In this area here, there's a lot of manipulation going on. So what's left is, where do we enter on the buy stop? And here's some of the tools that I use. This is how I use it. Okay, so the number one tool that I use, and I'm sure most of you guys are familiar with, is a trend line break. Let me redraw the trend lines here. So remember, we don't want to be the first to enter, and we don't want to be too late either. So finding that sweet spot, we use a trend line break. Okay, it could be rather steep depending on the slope. So this is where I would have drawn my trend line, and the entry would probably been this candle close here. Okay, number 2 is Fibonacci. Number 1, pattern break. 2, Fibs. Let me remove the trend line. This is not how usually people use the Fibs for. Usually they use it for retracement. But in this example, I wanted to wait for price to leave the area. I wanted to wait for price to confirm there is momentum to the upside before entering. What I would have done is entered on the 23.6% retracement, which is right about this candle here. Okay, so again, we want to see price leaving this area and showing that it's actually moving to the upside. And I would use the 23.6%, which just means that price has moved 23.6% away from this bottom here, from off the swing. Okay, and number 3 is it's just a pivot break. What I mean by pivot is not pivot points. It's actually this turning point here. See how it made a high and then it pulls back. So once price breaks these high, break this point here, this is a pivot break. We would enter right about here. Okay, pivot just means a turning point. Those are the 3 tools I use to enter on a buy stop. Let's take a look at another example. Okay, so here's example number 2, still on the New Zealand dollar. Let's take a look at this turning point here, okay? So price has been creeping up and it made a big impulse move to the downside. This signals a change of trend, and what we have here is the PRZ. So it used to be support, turn resistance. Okay, so the question is, knowing that this is a PRZ, when do we enter on a sell stop? Let's take a look at the second turning point here, not the first one. Okay. So the 3 tools again are trendline break. Okay. This is quite a subjective way using a trend line, because it's technically right if you're drawing a trend line like this and you could enter on the break here. It's also right if you draw it like this and you enter later on this break here. Okay. Number 2 is the pivot break. Sorry, the Fibs first. The Fibs, on the other hand, is a very objective way because we simply just enter on the 23.6. There you go. So you would just pull up the Fibs on the swing and you wait for price to leave the top here. We don't want to be catching tops and bottoms. And we'll simply enter on the 23.6, a sell stop. Okay, when price was still hovering above here. And stops would be above this point. So Fibs are one way, and the last one is a pivot break. And for this pivot, you could be using this point here and also this point. Okay, some of you guys may have entered earlier and you'll see price go back against you for a bit, but you still won't be stopped out. And for the later ones, you would enter over here at the break of this bottom. Okay, let's have a look at a few more examples. Alright guys, here's the last example I'm going to show you. Okay, here's what we have here: a move up and a down. Okay, so this is basically an area of PRZ right here. Okay, so price has turned, and we expect price to make a turnaround. Remember, PRZ is a zone. It's not just the single horizontal line that you expect price to magically bounce off of. Okay, so again, this is a really good example on when you should use a sell stop instead of just a limit order. Okay, to enter. As you can see here in this area, price continually tried to make a push to the upside. Okay, seeing a price action like this, you don't want to be the first to get in. You would have get in here. Technically, you have to put your stop loss above this point because price could go up to here and reverse, and it's still a valid short trade because it does not violate this high point here. And with that being said, if you have done that, your stop loss would be very wide. So in this case, I would wait for price to simply just turn around. Okay, to confirm that the direction is indeed turning to the downside. So again, let's use the tools here. First, trendline break. Okay. See how price respected this one last time before breaking it to the downside. We have about what, 4 candles while it was above this trend line, and we could have placed the sell stop just below the trend line. All right, that's number one, trend line break. Number two, we'll just pull a fib here. You have to see which of these swings make the most sense for you. Okay, and I will use this point here. This is just too wide. In this case, we'll enter on the 23.6, right about here, right there. And last of all, we'd have to draw a pivot somewhere here. This is the bottom of it. Actually formed a range here. Oops, let me just delete this. Yeah, this formed a tiny little support, and the break of the support, you would enter using a sell stop. Because remember, guys, the definition of a downtrend is lower highs and lower lows, right? So at some point, hold on. Price has to break this point here. This point right here. Okay, this point. So when this price makes a new low, then it signals a change of direction. So in this case, it would be this area here. All right. So those are the 3 examples on when I would use a stop order for entry and the tools that I will use to enter. I hope you guys find this video helpful. Be sure to leave me a comment if you have any questions, and give me a thumbs up if you like the video. Thanks for watching. Yeah.